Hello, everybody. Good afternoon, and thank you for joining our fourth and final Manufacturing Outlook webinar for 2019. 2019 has been a topsy-turvy year with some record highs and some record lows in terms of manufacturing performance. So I know many of you and many manufacturers across the UK will be looking forward to the Christmas period and hoping that it brings some festive cheer. But looking back over the last few quarters, what have been the main findings and what are the implications for the next couple of months? Well, if we look quickly at an overview of what I'm going to talk about shortly, in terms of this quarter's results, output has increased due to Brexit, stockpiling and the Christmas build-up. The seasonal Christmas period always brings a boost. Export orders have also increased for the first time since late 2018, albeit total orders have fallen slightly. Domestic prices are up, but margins are continuing to be squeezed, something we've seen earlier on this year as well. Investment, thankfully, is no longer negative, but it's not to a positive level that's worth really writing home about. It's still very low. And based on all of these results, our manufacturing forecast has remained stable for 2019 at 0.1% growth for the year, but has been revised down by 0.3% to 0.3% growth overall for 2020. And our macro forecast is up ever so slightly by 0.1% to 1.3% for 2019 and remains unchanged for 2020. Now let's get into the detail. Well, firstly, as you can see from the headline, stockpiling sees output increase, but orders fall. For manufacturers, 2019 has been a particularly tumultuous year, as the first two quarters saw stockpiling activities reach the highest level ever recorded in the G7 in anticipation of our original EU exit date of March 29th. Since then, orders and output have come to an almost complete standstill as those early year stockpiles were wound down. Now in Q4, we again see the effects of stockpiling activities artificially boosting output. Output rose from 4% on balance to 11% this quarter, albeit stockpiling has not occurred to the same extent as during Q1 of this year. This could be the benefit of or the result of a number of different factors. It could simply be a case of the boy who cries wolf, and manufacturers, having been marched up the hill and marched back down again so many times this year, perhaps not feeling like they wanted to do so again ahead of the Christmas period. It could also be the result of those stocks that were first built up in Q1 not yet having been fully run down, and therefore manufacturers not having as much of a need to do so this time around. Equally, we've seen a decline in export orders across the year, so perhaps that as well affecting the need for manufacturers to stockpile. One other possibility this time of year in particular is that many of the warehouses that manufacturers will have used previously in the year to use when they were stockpiling their goods in March and April of this year would have been pre-booked at this time of year by the big retailers ahead of the Christmas period, so simply weren't available this time around to stockpile, and therefore there was less capacity to do so. But nevertheless, we have seen some signs of stockpiling, but not quite to the same extent as earlier on in the year. On the orders front, domestic orders fell into negative territory for the first time last quarter, signaling that the vulnerabilities felt across the international markets were beginning to impact on the domestic market too. This is noteworthy because on average, UK manufacturers sit in the middle of global supply chains, importing an input, adding components to it, refining it in some way, and then re-exporting those parts to another factory overseas. So any downturn in international markets inevitably impacts UK-based manufacturing demand too. In Q4, domestic orders marginally improved, but this indicator nevertheless remains in negative territory at -5% balance this quarter. In more positive news, export orders increased slightly to 10%, enabling total orders to continue their positive trend. However, each consecutive quarter appears to bring total orders, the average level of orders from manufacturers, whether they export or not, ever closer to that ominous zero number. Moving on to the next slide. The Christmas boost was enough to ensure that the UK economy avoided a recession by growing by 0.3% in the third quarter. It had shrunk in the second quarter when Brexit stockpiles were unwound after the first Brexit date of March 29th. Two consecutive quarters of contraction would have signaled a recession. However, while it has held steady, the manufacturing sector failed to grow overall. as boosts in some industries, such as rubber and plastics, were balanced out by falls in other subsectors, such as chemicals. A focus of UK manufacturing performance on the international stage has always been a key element of our Manufacturing Outlook reports, given that 44% of the total value of UK exports come from manufactured goods. And our previous Outlook reported a steep deterioration in domestic orders, resulting in a negative balance of 6%. In this edition, we see the continuation of this trend in which domestic orders have performed relatively worse than export orders. Until last quarter, our surveys highlighted positive, albeit declining values across all measures of orders since 2016, the end of 2016. Q4 export orders presented an improved score of 10% this time around, up from the reported 6% balance last time. Although this is a positive result, international orders are still far lower than the level seen in 2017 and 2018. UK manufacturers face a particularly difficult challenge, as we are a highly trade-dependent country and firms are deeply integrated within global supply chains and therefore rely more on international trade than many other countries do. Unfortunately, as we've seen since the start of this year, foreign customers are switching away from the UK to new suppliers, with overseas firms attempting to mitigate the costs of Brexit uncertainty that they are feeling as well. Basic metals, mechanical equipment, electronics, rubber and plastics all reported negative balances from export orders this quarter. In a similar manner to Q3, companies in those sectors have struggled as export partners delayed or in some cases cancelled orders due to domestic uncertainties. By contrast, electrical equipment and metal products reported a very positive balance of 40% and 24% respectively. UK orders improved marginally but remain negative at -5%. This is particularly unusual as under normal economic conditions, domestic orders are typically less volatile than export orders. However, Brexit and other political and trade uncertainties have distorted the natural order of the business cycle this year, as I'm sure you're all well aware, with several stockpiling highs followed by stock clearing lows this year. And as such, UK orders now appear to be almost as volatile as export orders. Expectations for the next 3 months are more positive than that of the previous quarter, however, as the prospect of a no-deal Brexit has seemingly been reduced. In terms of our international trade and broken down by subsectors, one good bit of news is that the value of trade with the rest of the world is increasing. So since the beginning of Q2, orders have come to an almost complete standstill as foreign customers divested themselves of their reliance on the UK market. Orders from Europe, the US and Asia, our three biggest export markets, fell as overseas customers postponed or cancelled the orders from UK factories. Nevertheless, manufacturers are increasingly making concerted efforts to grow their markets overseas, and the result is that while the volume has not increased, the total value of our exports to the rest of the world is increasing steadily over time, and the average annual growth of exports of around 6% in value between 2016 and 2018. This is probably a compositional effect in the nature of the goods that we're selling overseas rather than a result of sterling, which is a very positive sign for sustainability for the future. Predictably looking to the future, as far as Make UK members are concerned, the EU remains the top of the list in terms of our important foreign markets in which we sell, and the top three is then completed by North America and East Asia, with the Middle East trailing closely behind. And manufacturers clearly expect the EU to continue to be the UK's closest trade partner regardless of the outcome of Brexit. Let's look a little bit now at the subsector breakdown. So our last edition reported negative balances for a number of sectors, although modest stockpiling reported, as I mentioned, restarted as I mentioned in October. It was not as large as levels experienced previously and therefore had less of a beneficial impact on output. Basic metals has been struggling the most all year. It saw a massive contraction last quarter due to the challenges faced by British Steel, coupled with the news that Tata Steel is to close one of its plants in Newport in Wales. Negotiations between British Steel and their prospective buyer, the Turkish Army Pension Fund, dragged on beyond the exclusivity period, resulting in that exclusivity period expiring, and those purchase negotiations were thus opened up to alternative bidders. The sale of the company now looks likely to go to the Chinese real estate investor Zhongyi, instead. And that £7 million deal, if it is to be confirmed, it's still subject to some regulatory checks and sign-off, but would give a welcome boost to the sector, which has really been in difficult times throughout this year, and scored a minus 29% balance this time. That is obviously still a negative number. It is a marginal improvement on previous results, suggesting that the sector is becoming a little bit more optimistic. Relatedly, metal products, of which basic metals is a key input, and has therefore piggybacked on the performance of basic metals throughout the year, also saw an improved performance this year with a balance, or this quarter rather, with a balance of 5%. Rubber and plastics experienced a decline in output, reporting a balance of minus 14%, with further contractions expected next quarter. Approximately a quarter of the rubber and plastics subsector is driven by the tyre market, which has declined as a result of the ongoing struggles in the automotive sector ever since the Dieselgate fiasco of a couple of years ago. The automotive sector has really struggled, and then domestically as well on the Brexit front, lots of firms shutting down and relocating parts of their production in the UK. So that has had a knock-on effect in terms of the impact on rubber and plastics. At the same time, increased consumer awareness of the environmental impacts of plastics, generally speaking, has generated social movements like the likes of which being Extinction Rebellion, and that's putting pressure on the sector, but potentially has a benefit for the paper sector elsewhere as well. But we will have to see how that peters out in the long run. It looks like it's going to be a significant change in that trend. The electrical and mechanical equipment sectors have reported a far better output than in Q3 this time around, a reflection of increased investment by manufacturers in factories and machinery, which I will talk about a little bit later on. Surprisingly, however, the electronics subsector, which has bucked the trend seen elsewhere in manufacturing this year and has performed really, really well, has now sunk into negative territory this quarter. It has been a positive force for UK manufacturing in recent years, with double-digit growth in output in 2018, followed by a strong 2019 as well. High global demand for automation products being the bedrock of that, although rising competition, particularly from China, has created a tougher market for its products recently. We're hoping that that's just a blip for the electronics sector, but again, it's one to watch out for, given that it has been an outlier overall this year. Switching to more granular level stuff on the business performances themselves. So domestic prices are up, but margins are continuing to be squeezed. So our previous survey saw the biggest quarter-on-quarter decline for both prices and margins since early 2017. A number of firms revisited their Brexit preparations this quarter, leading to higher levels of input purchasing and a build-up of safety stocks, and obviously that adding to the input costs. Manufacturers' expectations are for a more positive performance next quarter as the Brexit deadline has now been extended, and concerns about the potential crashing of the EU are less immediate, though the possibility has not entirely been eliminated. However, the divergence between UK prices and margins is still wide, and the gap between export prices and margins has in fact narrowed. For export prices, this is due to slow recovery in the value of sterling, which resulted in a reduction of the costs of inputs. This will come as welcome news to firms, many of whom have, despite their costs going up, refrained from increasing prices. And instead offer discounts in an attempt to retain foreign customers who, as I've mentioned before, have been looking elsewhere and been tempted by other markets. On top of this, a tight domestic labour market has continued to push wages up by about 2.7% between June and September of this year, adding to the cost of doing business. Something again of note is that more than 210,000 UK workers will enjoy a Christmas pay bump if their employer is a member of the Living Wage Foundation's voluntary living wage campaign, and the 6,000 businesses nationally who have signed up to that voluntary scheme will lift their hourly UK rate by 30p to £9.30 an hour. People living in London will see their minimum hourly pay up by 20p to £10.75 an hour. The compulsory national living wage, which is £8.21 an hour, is the legally binding rate for workers aged 25 or over, and it's reviewed annually, the same as the national minimum wage. But something, again, just worth keeping an eye on is that with the general election on the horizon, the Conservative Party have promised to increase the national living wage to £10.40 an hour by 2024 and to lower the minimum age one needs to be to receive it to 21 years of age. The Labour Party, for their part, say that if they win, it would immediately lift the hourly rate to £10 for everyone aged over 16. So a potential significant extra payroll cost coming down the line for manufacturers. Added to this, according to the Resolution Foundation, government spending is likely to hit 1970s levels over the next Parliament, no matter which party wins the election, and obviously many businesses will have to foot a large part of that bill. As an additional note, in the last 3 months, the Brent price of oil returned to its normal volatile nature following a brief upswing that saw oil prices increase by 20% overnight in the aftermath of the attack on the Saudi oil refineries, those drone attacks not so long ago. But excluding that brief period, the price has varied between $55 and $65 a barrel. And notably as well, OPEC are expected to meet in December to discuss a possible increase in oil prices as well. So that could have an effect on the energy price domestically here also. So what has all this meant in terms of business confidence? Well, despite all the bad news and the difficulties that many manufacturers have been having this year, expectations are for a more positive rest of the year. Between Q2 and Q3 this year, confidence collapsed to levels not seen since the referendum period in 2016. However, our latest results present, as you can see from that chart, a much more optimistic view. Firms saw mild improvement in business confidence, and although the degree of optimism remains low in overall terms, it's nevertheless a welcome improvement on previous quarterly results. The economy has been in stop-start mode all year, with periodic growth punctuated by repeatedly postponed Brexit deadlines. So looking ahead, ongoing political, economic and trade uncertainties will continue to strongly influence the sector's performance. However, as mentioned earlier, export orders have increased slightly this quarter, indicating greater confidence from foreign customers about purchasing UK goods in the months leading up to the holiday period. And that in turn has fed through to UK manufacturers' confidence themselves. So investment this quarter has improved slightly, and it has really been the one area where we've really struggled all year. It is the bedrock of all growth in terms of boosting productivity, in terms of increasing business performance. So it's been quite worrying that across this year, investment has been so poor. And following that series of declines this year, thankfully, it has begun to pick up. Employment intentions are now also stable after 4 quarters of consecutive declines. Albeit the PMI results indicate that for the last 8 months in a row, job losses have been quite severe. But future intentions seem to be fairly stable, so hopefully that seems to be bottoming out. And confidence across the industry has increased, as I mentioned on the previous slide. So as a result of all of this, many firms expect the gap between output and orders, in essence a proxy for the measure of whether a firm is making money or not, is expected to reduce. In other words, manufacturers are hoping that over the next 3 months, business activities will return to a more normal pattern, and the feast and famine, which has been a constant throughout this year, will hopefully be coming to an end very soon. The results of all the stockpiling and the political and economic and trade uncertainty has been 3 years of damaged business investment. And while the slowing Eurozone and global economy are also reeling from trade disputes as well. So we're really in the middle of a perfect storm. And this is the 3rd year in a row where the World Trade Organization has lowered its growth forecasts for trade for the coming year. So they're not overly optimistic. But nevertheless, the uncertain growth is likely to make banks more reluctant to lend. And it's also worth bearing in mind that the Bank of England's regular survey of banks shows that UK lenders are increasingly concerned about the business outlook. And as a result, they have started to cut back on lending to corporates, and corporate bankruptcies have started to peak up a little bit. So while we have seen an improvement in investment. It is still very low, and it might just be a temporary boost. It really depends on what happens over the next few months in terms of the political and economic news that we see. Future quite positive. And contributing to the investment paralysis have been significant factors, including the outpouring of equity funds from the UK overseas. So over the last 3 months to the end of September, a total of 2.3 billion was withdrawn from the UK equity markets, which is the worst quarter in history. So again, seeing a mixed signal on the investment front, but at least manufacturers looking to invest more. The subsector that has seen the largest negative employment score as well is the non-metallic sector. This subsector predominantly deals with intermediate goods for the construction sector, and while there has been very little construction activity going on, that has obviously had a knock-on effect as well. So another sign of a proxy for the role that investment plays in the overall economy. So overall, a bit of a mixed picture on that front as well. What does this mean in terms of our forecasts for the coming year, or for the coming quarter rather? Well, as I've mentioned ad nauseum throughout this year, Brexit uncertainty combined with global trade tensions has been a real troublemaker for the manufacturing sector, and we now reckon that GDP is about 2.5 to 3% lower than it would otherwise have been. That's about 55 to 66 billion pounds worth less in GDP terms for the UK economy. That being said, some of the signs this year have been, or this quarter have been very positive. Investment has picked up. Employment intentions looking more stable. Export orders increased slightly, having declined across the board almost since the start of the year. So overall, I would say that manufacturing is ending the year in a bit of a standstill, and our predictions, which are based on our close understanding of the UK economy and the manufacturing sector in particular, are a little different, but not hugely from our last quarter's outlook. So our forecasts for the manufacturing sector for 2019 is for an overall growth of 0.1%. Not worth boasting about, but still positive growth, albeit we expect slightly revised down figures for 2020 and are now anticipating 0.3% growth for the year ahead. Our macro forecast is up, however, 0.1% for 2019 to a result that we expect for the overall for the year of 1.3% and has remained unchanged for 2020. So I will hand back to Bal now and thank you for listening.
Good afternoon, everyone. It's Juliet Wallwork here. I'm just going to talk through 4 or 5 slides on Brexit and where are we now. So, what's the current timeline looking like? On the 17th of October, the EU and the UK agreed a new withdrawal agreement. This was introduced into the House of Commons on the 21st of October. But obviously because of the political situation, it's made no further progress. So the next big date on the timeline is the 12th of December, when we'll have the UK general elections. From a Brexit perspective, there could be 4 potential outcomes from that. The withdrawal bill will pass through Parliament, we'll have a second referendum, there'll be a no-deal scenario, or Article 50 could be revoked. But from the key dates, the next date we're looking after that is the 31st of January 2020. Now, this is the current default position from when the UK will leave the EU as per recent negotiations, and if the Conservatives win a majority, this is a likely outcome. We could even potentially leave earlier. There is a flexible extension provision in there. If Labour wins, there is talk of a second referendum, but apparently it will take 22 weeks to prepare for one of these, so a question mark as to whether that could be done before January 2020, in which case I think a further extension would need to be requested from the EU. So if we look at the scenario where Conservatives are returned with a majority and we the withdrawal bill is agreed and passed through Parliament, then the next key date would be the 1st of February 2020, when the transition period or the implementation period would start. So at this stage, whilst the UK would have formally left the EU, we would still be aligned with EU legislation, particularly around trade and customs. So the headline here is that we would see no real change in this period. We wouldn't see the introduction of tariffs. We wouldn't see the introduction of any customs reporting requirements. What we would see, however, potentially is the loss of access to any EU third country free trade agreements, which is a particular area of importance for manufacturing, particularly those that are exporting to key countries. Now, the implementation or transition period is due to run for a year until December 2020. However, if the EU and the UK agree, there can be a one-off extension to that period by up to 2 years, but this would need to be agreed by July 2020. So what are the various scenarios from these timelines? Well, as I said, if the withdrawal bill is passed and we do see this transition period, then EU legislation will continue to apply throughout that period. As I said, we won't see any changes to moving goods between the UK and the EU. We won't see the customs declarations. We won't see any tariffs or additional costs. If the withdrawal bill is not passed, and we have a no-deal scenario, then we are back where we were at the end of October, and we will potentially see the requirement for customs declarations moving between the UK and the EU and tariffs imposed. Now, the government did talk about the introduction of UK-only temporary tariffs, which would reduce to zero the tariffs on a lot of products, about 85% of products. However, this was a measure that was introduced by the Theresa May government, and we know that the current government of Boris Johnson does not necessarily like these. So any companies looking to rely on these as zero rated for goods coming in from the EU, it's a risky strategy. Now, depending on who wins the election or the outcome of the election, we could have a second referendum. So the country may be given the opportunity to vote again on whether or not it wishes to leave the EU. But as I said, there are certain timeframes around this, and it would require the agreement of the EU to extend Article 50 again. The final option, of course, is that Article 50 would be revoked and the UK will remain in the EU. So there is still a large degree of uncertainty out there. We will know more, obviously, after the results of the election on December the 12th. But what I would say is, even if we do enter into a transition period, there are things that companies can be doing now to prepare, because under those scenarios, we will see a point when we do leave the EU and we stop being aligned with EU customs legislation. And that could be as soon as December 2020. So, a few key areas to consider. Companies need to understand their supply chain, and they need to understand what customs data they hold. So things like commodity code, classifications, values, descriptions of products, all of these, particularly in relation to goods that move between the UK and the EU, companies may not have that data. When and if companies are required to submit customs declarations, this data and this data being accurate is going to be key. So it's a good exercise to do the housekeeping on this now and to make sure that that data is up to date and complete. Companies should look at their shipping terms. This is something where we've found a lot of confusion when we've been speaking to clients over the past 12 months, is things like ex-works, things like delivery duty paid. What does this actually mean for companies? If, for example, you are a UK supplier to a customer in Germany and you're currently operating on a DDP terms in your contract, won't really have that much commercial impact for you at the moment, but post-Brexit, it means you would have responsibility for submitting customs declarations and reporting requirements in both the UK and the EU. Now, the UK obviously will no longer be in the EU, so there may be some restrictions as to whether you can actually carry out that function in the EU. You may have to consider things like fiscal representatives to help with that process. Likewise, if you are buying on an ex-works basis from an EU supplier, you therefore are responsible for the export declaration from the EU and the import declaration into the UK. Now, under EU legislation, you can only submit an export declaration and be the exporter if you are established in the EU, not even VAT registered, but established. So again, these legal requirements could impact your current arrangements with EU suppliers and customers, and you need to consider these now. Another area to think about is your resource and your customs knowledge internally. Because customs duty has not been at the forefront of UK taxes for a number of years, and because we have traded freely with the EU when it comes to movements of goods, there is a lack of knowledge internally within companies about this, and this links back into understanding supply chain and reviewing the customs data. Now, the government is giving training grants at the moment to help companies improve their customs knowledge, and I'll come on to that in a couple of slides' time. Other areas that companies should consider is if you will see the imposition of additional tax costs, additional duty costs in your supply chain, because duty is now being charged when goods move between the UK and the EU. Consider duty reliefs. Things like customs warehousing, processing relief, these things could help to take additional cost out of your supply chain and maintain the current status quo. But in order to get these reliefs, companies have to show a good level of customs compliance, which links back to my points on customs knowledge and customs data. Finally, companies might want to think about applying for Authorised Economic Operator, or AEO. This is a trusted trader assurance scheme. It's a gold standard. It's part of a global framework of trusted trader assurance schemes, mutually recognised globally. At the moment, UK companies form part of the EU authorisations, but it's intended that the UK will have its own version of this. In line with the UK authorities and other EU authorities and global customs authorities' approach to take a more risk-based approach to keep trade moving, what we will see in the future is companies being judged by whether or not they have these assurance schemes. And if they do, they will see faster clearance times, less compliance, less audits, and the way they can trade will be made a lot easier. Now, one of the indirect consequences of Brexit that we have seen is in preparation for this, HMRC have recruited over 3,000 new customs and border control officers. Now, at the moment, these officers have nothing to do because Brexit has not yet happened. So what we are seeing in the market and in the industry is that these new officers are being deployed, if you will, to companies where they're carrying out customs audits and compliance checks. We've recently had a number of queries from companies asking for assistance because they have been subject to this process. Now, HMRC can, not only if they find any underpayment of duty or import VAT, they can go back 3 years to obtain these taxes back from the company. They can also levy financial penalties for technical errors. So even if a company is not underpaying duty, but it's making a technical error in its legal compliance with the customs legislation, they can receive penalties from HMRC. And these penalties can go up to £2,500 per error. So if a company is importing or exporting and submitting a number of customs declarations a year via its freight forwarders, and the freight forwarders make an error in those declarations, and HMRC discover it during an audit, that company could be liable for up to £2,500 per error. So it's something which companies need to be taking very seriously, particularly if we have a transition period. We will have that period of time before Brexit really kicks in which case we expect HMRC to carry on with its current programme of audits and compliance checks. So the final thing I just wanted to mention today, leading on from that, is that there is a potential opportunity at the moment to secure a government grant funding for customs training from third-party advisors or suppliers like BDO. Unfortunately, this is time-limited. This is the third wave of funding, and we understand that this will run out or will be closed in mid-January 2020. We've put the link there if anybody is interested in looking into this any further. I would recommend this if you have a company and you feel that the customs knowledge internally is maybe not sufficient. It's a great opportunity. We don't know if the government will introduce a fourth wave of funding. This may be the final one. So it's something that I would urge companies to consider. Thank you.
Thank you, everyone. We've had one question come through, and this is for Seamus. So the question is, Seamus, where do you see the niche manufacturing opportunities for manufacturers after Brexit?
It's a very interesting question. I suppose I need to start off with a disclaimer that I'm not a financial advisor, so anything I say is based on just my understanding of what we've seen across the sector for the last couple of years, and the kinds of trends and where they're headed, but it shouldn't be taken for legal or financial advice. That being said, I think the one area that really stands out for me is the electronics sector. For the last couple of years, it has outperformed the rest of the manufacturing sector. It is the one that caters to the growing demand for technologies that feed the need for automation within factories and in consumer goods. And despite all of the difficulties that we've seen, not just with Brexit, but across the board in terms of the slowdown in the Eurozone, in terms of the growing global trade wars between the US and China and elsewhere, and how that has disrupted performance across the manufacturing sector, electronics has been the one outlier. It has seen very rapid growth for the last couple of years. A slight blip this time around in terms of this quarter's results, but I am expecting that to be just a blip. This fourth industrial revolution and the need to automate to stay competitive is going to continue no matter what. So that is a sector I think that is going to continue to do very well and is worth considering.